We'll take the discussion on markets forward with Feroze Azeez, Deputy CEO of Anand Rathi Wealth, joining us on the show. Feroze, afternoon. Thank you so much for your time. First of all, I'd like to understand from you, look at how bond yields after a very sharp fall have rebounded. Even the dollar index for peaking out 107, closer to 101 rebound. It was, or is market taking this for granted that mid this year rate cuts in US may actually start? Are we taking it for granted? Perhaps, who knows that inflation in US may turn out to be sticky and hence rates could remain higher for longer, because this has happened in the past as well. What are your thoughts?
Good evening, Ajay ji. Happy New Year to you and the viewers as well. Like you said, of course, there is some degree of market has this tendency to discount any information which they can think with a high probability event. Like, for example, from an Indian context standpoint, if the high probability is that the government will continue, the market start discounting higher probability events and forgets the low probability events. And when the low probability events happen, the markets give a knee-jerk reaction to adjust for that discounting. Now, coming to the particular question, Ajay ji, are they discounting rate cuts? Yes. Yes, mid next year, mid this year, now that we are in the year already, there is discounting. In fact, if you look at how we look at it, is because we are fundamental guys, we're managing long-term monies. We look at how many rate cuts all central banks globally are expected to give in this calendar year. My estimate is 140 to 150 total rate cuts, all central banks put together. If this were to happen, then you are very good. Because transactionally, the FOMC minutes might say differently. But if you got it strategically right, the rate cycle across the globe, then it helps. Because FII money comes from different sources as well. It's not just the US. So from an investor standpoint, the money is made on capital markets, not on rate cuts. Because debt is not what people are so worried about when they're looking at rate cuts. They're looking at its impact on the equity markets. So to answer your pointed question, our estimate is about 140 to 150 rate cuts, all central banks put together. And I think the higher probability event is to discount, and rightly so, the rate cut cycle coming in anytime in the mid of the year.
The point I was reading in Economic Times this morning is that the D Street is likely, the primary market part of the D Street is likely to be very vibrant in 2024 as well. And why not? Flows from HNI retail domestically, FIs have also pumped in $11 billion this year and maybe warming up more. Is this also a bit of an issue to suck the liquidity? 50,000 crore worth of IPOs came in 23 and almost double are expected to hit the D Street in 24. Is this a risk to suck out liquidity, which was otherwise meant to be coming the secondary market way?
Ajay sir, 2 points. Yes, you're absolutely right. FIIs have been pumping in money, but I think it's still scratching the surface. If you look at the December numbers, some $7-8 billion have come in. And I think if government continues, the capital markets have this immense affinity towards continuation of any government for that matter. If you look at and see the reaction of FIIs on the date of general elections last 5 times, you would see that they hate change. They love continuity. And if that were to happen, this money is very abysmal. The kind of money which is waiting to get into India, I think is in magnitude very, very different and very high. That's point one. Point two, I think FIIs, when we speak of FIIs, we generally look at the split between their allocation between large cap, mid cap, and small cap of the money which has come, which is a number which is not tracked so much, but that's a very good number to understand how they behave in India today vis-a-vis in 2018. The FII allocation to small cap was as good as nothing. Now there is a reasonable portion of FII money going into small caps. India's story is being played by the FII, not in the top 50 or the next 50 Nifty stocks, but the NSE 500 stocks, which is a huge game changer because re-ratings in the small cap is very easy to do because they are smaller market caps. If there is a 10,000 crore market cap company with a free float of 3,000 crore market cap, if an FII decides to buy 100 crores, he will re-rate the PE himself or herself, if I want to refer them with a fairer gender. So that's the point I'm trying to make on an FII standpoint. Now coming to the point of where a short-term variable, which is very, very critical, is the domestic liquidity. Also, if you try and decipher the kind of domestic liquidity, unfortunately, SIP numbers total for this year are greater than the total net sale of equity mutual funds in India, which means the HNIs have redeemed money. And I think retail has been very smart over the last 2-3 years, but HNIs have been selling money from equity because of the over-analysis and the pessimism which is coming resultant to the overvaluation hypothesis which the HNI is doing. So I would love to believe that HNIs should follow retail this time around than the retail following the HNI. At least the numbers say so. We've lost about 30,000 crores in equity mutual funds other than the SIP number, which I think is saddening in a year where Nifty has gone up about 30%.
What a point. That's something very nice. Actually, I was coming to it. So, let's scratch it a little more. Anand Rathi Wealth is doing so well, catering to retail HNI across the country. I want to understand the HNI sense right now. They have been, in fact, it's 8 years in a row we have had positive returns from the Nifty, right? And they've made a lot of money. Are you telling me that the HNI bunch is now turning slightly skeptical and are in the mood to take profits?
I think, yes, whenever there's a 30% rise, I think some degree of profit taking happens. But I think money management is both heart and the mind. Of course, Ajay sir, who knows it better than you do. What happens is people have something called the recency bias, which means that they keep buying the asset which has done well over the last 1 year. It becomes very difficult to be prudent and rebalance their portfolio. Rebalancing as an academic activity seems a very practical thing, but in actual world, people don't rebalance. When Nifty has gone up 30%, for example, our model portfolio has beaten Nifty by 12.5% this year. If that's the kind of return, clients don't walk up and say, why don't we rebalance it and put some money in debt? They would say, why don't I buy some more equity? So we as a distributor, our job is to show the data and bring back sanity and remove the recency bias. That's one of the key job roles we define, to remove the heart element and bring more mind in it than the heart. So to answer your pointed question, HNI is not booking as much profit as he or she should, because rebalancing is a need of most portfolios in India today, because debt has given 6%, 7%, at best 8%. But on the equity side, people have made 35, 40% as well.
Fair point. Before we wind up, just a quick word on for 2024. What's the Anand Rathi Wealth market outlook, which you have actually given out to your client community on? There are a variety of factors, right? Global factors, elections, earnings, and plus many of your clients are sitting on very good returns thanks to any smart advice from you guys. So for 24, what are you telling them? What's the strategy to adopt?
The strategy to adopt is to have naked equity of about 55, 60%. That's what we do. We also do something called structure products, which is not naked equity, gives you the little plan B kind of a feel, where if the markets don't do well, they become your great fallback option. That's what has been proved over the last 11 years of we doing it. But to answer your pointed question, what we are telling HNIs is be invested in your equity to at least the extent of 60% naked equity, point one. Point two, don't quit small caps just yet. The kind of liquidity which is expected there is also not drying up. That's point two we are saying. Point three, which is very important, is basically if you look at the allocations across different assets, people should exit out of real estate because they are not giving double-digit returns and they're not expected to. We are telling them that the nominal GDP over the next 5 years for India is going to be between 12 to 14%. And Nifty has proved time and again that it replicates nominal GDP over 5-year periods. Earning estimate for Nifty for the next years for us is about 1,080, which I think is healthy from a 965, which is the financial year. We have expected earnings growth when Nifty earning was at 532 rupees. During peak of COVID, August, we released a report that earnings are going to go through the roof, and that's what ended up happening: 532, 777, 821, 965, and 1,080. This is the kind of fundamental earnings growth, which is what medium-term markets derive out of their direction. The direction is derived out of earnings growth for the medium term, and economy takes the driver's seat for the long term.
Excellent. All right, Feroze, thanks so much for dropping by, for your time today.